Hello and welcome to Find of Facts. Today we are talking about the RBA, who just announced they will be keeping their record low cash rate of 0.25%. Now what does that mean? Well, I'm talking to Finders Insights manager Graham Cooke to find out. All right, Graham, tell us, what does the hold for the RBA mean?
So, in theory, it means that homeowners, people who've borrowed money from the bank, shouldn't have to worry about the cost of their home loans increasing for the foreseeable future. Usually, the cash rate determines the cost to banks of borrowing money from the central bank, and that then determines the amount they charge when they're lending money to the consumer. So normally, when the cash rate goes up or goes down, the interest rate they pay on your mortgage goes up or goes down pretty much every single time. Also, your savings rate will change, but the biggest impact will be to mortgage holders. So normally, the cash rate not moving would mean no increase to mortgage costs for people who are paying the bank back for that type of lending.
So as long as the cash rate stays flat, the mortgage rates will too, right?
Yeah, well, generally that's what you would think. But if we have long periods of stagnation, you tend to see the banks move the rates, what we call out of cycle. So that means when the banks will increase or decrease their lending rates to consumers when the RBA haven't moved the cash rate. Now, the last time we saw a long period of the cash rate still was starting in about 2018. There was 36 months of flat cash rate. It sat at, I think it was 1.5%, and there was no movement for a very long period of time. It was always a struggle in Finders to try and find something to write about the cash rate during that period because nothing was happening. Basically, the National Bank still moved their variable rates about 7 times over that 36-month period. So it doesn't necessarily mean that the rate is locked in for consumers. And in our current survey, in Finder, we survey economists, and we asked them what they think is going to happen to the cash rate in the economy. They all predicted the RBA would hold the rate, but more than half, 57% of them, said that they expect banks to be increasing rates over the next few months, even though the cash rate will probably stay still.
How do the banks justify this?
That's a good question. Well, the last time they increased rates out of cycle, they blamed increased international funding costs. So basically, the bank is saying, the cost of doing business has increased, even though the cash rate hasn't increased. That it means there's an increased cost to us, and therefore we need to increase the rate we're charging consumers to kind of protect the bottom line, to make sure the bank is secure. And I'm sure there'll be a pretty similar argument in future if banks do increase rates over the next few months. With a lot of people potentially defaulting on their mortgages, a lot of people taking mortgage holidays, investors pretty much disappearing from the market, and even owner-occupiers becoming more of a scramble for the increased number of banks on the market to fight over. We could very well be looking at a solidly reasoned argument that banks' cost of business is increasing, and that they could use that as an excuse to increase interest rates.
Okay, so how much of an increase could homeowners be looking at here?
Nobody really knows. If we look at the last period, that 36-month period I was talking about, 2018, when there was a bit of movement, I think it went up by about 0.25% over the full course of the 36 months, something like that. So you could be looking at a 0.25% increase in the next couple of years, potentially. We asked economists, interestingly, when they think these rate moves might happen, and half of them said in the first half of 2021 could be when we're looking at those rates increasing, and the other predictions were spread out towards the end of this year or after that period. But generally, when you're looking at borrowing like this, it's very tempting to jump on a home loan in this low rate environment with house prices falling and everything. It's very tempting to take advantage of those government schemes and jump on the housing ladder. But you do really need to make sure you can afford to pay back not only the loan at the current interest rate the bank is charging you, but you need to add at least 2% on top of that and make sure you can afford that as well before you jump on the housing ladder.
Thanks for that, Graham. That's the facts for today, though. Make sure you hit the subscribe button if you want to see more videos like these. Hit up our expert explainers or get some money hacks that'll help you save money and make money. Until next time, see you later.